webcast is now starting. All attendees are in listen-only mode.
Hi, everyone. Thank you so much for joining us today. We are just going to give everyone another minute or two to join the webinar, and we will go ahead and get started. All right, everyone, I think we'll go ahead and get started. I know people will continue to trickle in, but that is perfectly fine. So I am just going to kick things off really quickly. Thank you so much for joining us for today's webinar. My name is Lauren Izoni, and I just help coordinate the trainings here at CC Pace. Just wanted to give you a quick little reminder about our GoToWebinar platform. If anyone has any questions throughout the webinar, just submit them in that question box, which is located on the right-hand panel of your screen. And we are going to do our best to answer as many as possible at the end of the webinar. So with that, I will go ahead and turn it over to our first presenter today, Bill Lehman.
Thank you, Lauren. Hi, everyone. My name is Bill Lehman. I am the Director of Process Transformation here at CC Pace. CC Pace is a management and technology consulting firm with a financial services vertical and a mortgage boutique. We formed a partnership with Firm Advisors last year in order to be able to assist clients in their LIBOR transition by providing education, performing assessments, creating programs, and then executing on those programs. I'm now going to turn the microphone over to Mohit Sudhakar from Firm Advisors for today's presentation. Mohit?
Thank you, Bill. Thank you, everyone, for joining. It has been short notice between Monday and today, and we are thrilled that we have a full sellout here. And we're looking forward to conversing with you about this transformation and this transition journey to first provide you an overview of, the overall awareness around the issues, and we're going to dimension it and segment it in conversion, adoption of SOFR, and then to assess your own readiness as well. Well, the latest catalyst in this New York is the New York DFS letter that came out over the holidays, asking for many people's plans about what their plan is for this transition. And that's the namesake for this presentation, saying, does your plan measure up for satisfactory reasons? The best way to describe this journey is like a train that is going from DC to New York. It travels, it used to travel on a track that was the LIBOR track. It used to travel well. The track is very old, and for very many reasons, it's being taken apart, it's decaying, and it will vanish before the end of 2021. So the other shiny track, which is the SOFR track, has not been built yet from the New York side. And the hope of everyone is that it will be done in time for the train to transition with all its passengers onto the new shiny track before 2021. In this webinar, we'll provide context, debunk some misconceptions that may be out there. We'll provide awareness of the extent, depth, and complexity of the issues and the multidimensional nature of the transition and the transformation. So like I said, we're going to segment this in conversion, adoption, and what are the gaps that are going to be in between, and preparedness and readiness of the industry. Well, there's a general misunderstanding that this is probably a repapering and a legal exercise. Not true. There's probably a misunderstanding that there's operationally we can get the similar kind of data from similar kind of screens and plug it in. Not true. Process-wise, there may be a misunderstanding that we can apply the same sort of mechanics in the same way. Not true. There may be a misunderstanding that with some adjustments, the conversion and the transition will be okay for the whole world, all at the same time, before 2021. That's going to be a big, big challenge. And why I say that is because let's frame the context here. There is immense scale, depth, and complexity of this issue, and the timing itself is very short. All financial products include instruments, agreements, contracts, data, calculators, models, risk metrics, platforms, payments. As you can read, the governance issues, the business issues, the operational issues, they're all going to be impacted. Why are they going to be impacted? Because LIBOR, wherever it is lurking in the system and being used as a rate for reference, is going to be impacting those particular instruments, products, models, etc. But the problem and the issue is more pervasive than that, because anything that uses LIBOR for discounting as well, that too is impacted, and therefore the issue is much larger than we think it is, or most people think it is. SOFR and the transition itself to SOFR is going to be very challenging because it is significantly different from LIBOR in concept, credit, construction, term, and calculation, that it cannot be a simple replacement. It's going to be a very complex business and financial and operational plus technology issues with lots of accounting and tax considerations as well, and for converting the legacy book of business and transitioning to the new one. Let's quickly talk about the issues from a macro level. We've heard from everyone, this is what everybody knows now. LIBOR is the most referenced rate. It's this, it's that. There are $200 trillion worth of securities out there. Well, what does it mean? It's all stale news now. We know it's going away. We know what's impacted. What is not stale is the pervasiveness of how deep it goes, how deep the rabbit hole is, and directly for rate as a reference, as well as for its valuation indication. So something needs to be done about these trillions and trillions of dollars of securities, derivatives, no matter the flavor of the instrument. The choice is going to be either it's going to be done by you, or it's going to be given to you as what it needs to be done by the regulators. And that's what ARC and the ISDA are trying to do right now. Well, how did we get here? And why does this slide matter? After 2008, a number of the contributing banks were found by the regulators to have manipulated LIBOR. As part of their acknowledgement or not, there were many fines imposed, billions and billions of dollars. The regulators wanted to have their own ARRs, new developed ones that were going to be different from the LIBOR. And regulators went on this spree of creating new alternative reference rates, and the choice of reference rate in the United States is SOFR, that is being propagated and supported and championed by the New York Fed, as well as the Federal Reserve. There are other choices as well that are coming up, but they will have their own set of challenges as well. So the sponsored one is SOFR. Why do we think that that there is no possibility of extension? Many folks may be thinking that we're small, we can't adjust to it in time, we might be given a chance to extend. Well, not true, because the banks, the contributing banks who were providing all this information were the ones that were fined. And these guys have now gotten a free pass from the FCA, that's the Federal Conduct Authority in England, saying you may not do this after 2021. There is no reason for the contributing banks to provide this. And plus, since 2008, the number of participants have already declined, and the quality of LIBOR itself is becoming unreliable as we go on even closer to 2021. So it would behoove everyone to start to move away into SOFR as quickly as possible. So what's this DFS letter asking for? They're asking for a plan that identifies, measures, monitors all your financial and non-financial risks. What are the processes for analyzing the alternative rates? What are the institutions for each institution, its customers and counterparties, what the communication plans are going to be, and how you're going to transition them everything at the same time, what is the best way to do it, and the process and plan for operational readiness and communications. Lastly, but not least, is the importance being given to this transition so that there's a governance structure at the top level for the organization. Over the holidays, 3 weeks ago, the regulators put out a letter, and this letter is the DFS letter we're talking about. Why did they put it out in such an urgency? Well, they're all very concerned about the progress or the lack of thereof that they're seeing, and they're now asking for a plan. I mean, everyone has a plan. The question is, how mature and robust is that plan? Is it mature enough to put on paper? Is it good enough to share internally? Is it good enough to give it externally and communicate with everyone else? Is it good enough to show to the regulator, to your shareholders? You need to have a plan. The regulators are forcing the issue at this time. And it's a very short fuse. Not everybody has the skill set, the resources available all the time, and we're here to help. Just wanted to say that because we can help you dimension your own set of issues. Everybody of a different scale is going to have different sets of issues. We can help dimension the issues because they're not simple, and we'll just explain why. The operational, the financial, and the legal assessment will need to be done. That's going to be asked for. That is being asked for. There's going to be a plan that's going to be asked for implementing those things. All these things will need to be done, and we can help. Okay, this is where we segment into the first LIBOR conversion set of issues. What is really the problem, and why is it a problem? Well, the biggest problem is the enormity, the complexity of things, and the deadline that is out here. This is something that we just spoke about as well, right? So what needs to be done? What needs to be done is there are lots of business products that need to be transitioned over. It's not going to be just the LIBOR products, but as we showed you in previous slides, there are a variety of different products. And at a banking level or a corporate level, there are a number of different departments that might be doing different products that reference LIBOR. There needs to be a cohesive plan to transition most of them at the same time, and at the corporate level to assimilate all those risks at the same time. And for doing the paperwork itself, the legal remediation, well, how do you assess what the exposure you have? The exposure is not merely, oh, I have so many dollars of exposure out there. The exposure is basically understanding what are the risks associated with that as well. Let me give you an example. So if we speak about looking at the entire block of legal paperwork that you have for a variety of different kinds of instruments, to be able to segregate it, call it triage, it on the basis of, hey, this is something that has good fallback language, can be done at an industrial pace, great. This particular bucket has no fallback language, needs to be babysat by lawyers and everybody else, great. What about the in-between? To assess the strength of the fallback language, Do you have it robust enough that it doesn't require litigation? We don't know that, but that's the assessment part. Which bucket does it fall in? Is it the risk bucket or the non-risk bucket? And to do all that reconciliation and assessment, it's very important to do a good-sized assessment of these things, and to be done in an automated way, to do this, to do it in an automated way so that time, cost, and error is saved. And then you don't have to spend as much on lawyer time. Okay, so those are the things, and the choice is going to be basically, do you want to make these choices, or do you want the regulator to make these choices for you for this legal remediation? So let's now quickly jump into why SOFR is so different and what does it mean. Well, it's very different from LIBOR in concept, credit, construction, term, calculation. There are a whole bunch of other things one can see, right? You see this chart here. What does it mean? Let's look at the first one very quickly, okay? It's a risk-free rate versus a representative rate for the banks that used to do LIBOR in London, right? What's the second point? It means credit, okay? Credit of whom? So SOFR is, so whereas, banks of a certain grade of credit used to trade with each other at LIBOR, that's not going to be the case with SOFR. So what you're going to have is Bank A, who has a higher credit rating, would lend to Bank B at a different SOFR rate, SOFR plus something or minus something, and SOFR plus something, I would think. But that rate, but the cross back would be at a different spread. So we need to think about that. In terms of construction, there are a whole bunch of issues here, whether it's that SOFR is backward-looking and LIBOR was forward-looking. What does it mean for most institutions for this purpose? Consider that with LIBOR, you knew ahead of time on a payment that you are going to make in 3 months from now, for example, if something were tied to 3-month LIBOR. So 3-month LIBOR plus 50 basis points, let's say, would have been your payment. You knew that 3 months ahead of time. With SOFR, that's not going to be the case because it's backward looking. You're going to know what payment you're going to have just a few days before. And those days, number of days, have also not been harmonized yet. And they have not been standardized. There are some that are 2 days backward looking, 3 days backward looking, 5 days backward looking. This creates fragmentation in the industry, and the industry needs to collectively move towards a common goal. Okay? Term. What does term mean? LIBOR had many terms, daily, weekly, monthly, quarterly, semi-annually, annually, so on, right? Whereas SOFR is overnight only so far. So far, SOFR is only overnight. And the term structure of this still needs to be developed, and that's the one that's holding many folks back in moving over their cash products to SOFR as well. So New York Fed has made it much easier for everyone by publishing the calculated rate, the computed rate on their websites. But again, it requires a lot of transition and taking up these numbers from their websites as well, and from other data providers like Bloomberg. Okay, so point number 3 about conversion-related issues. There are lots of issues about converting at a systemic scale. So the regulators are trying to force the issue, saying we need to move things very quickly and in a synchronized way across the industry. And therefore, they're trying to make an adjustment. And the adjustment that they're trying to make is to have a common, one single uniform spread for all cash products, regardless of complexity, tenor, maturity, credit, seniority, level of participation, creditworthiness. No matter how you look at it, it's going to be a common replacement. So something that was a LIBOR plus 200 will become a LIBOR plus 200 plus X. And that X is going to be common for a much more complex instrument if it were LIBOR plus 500 it's going to be LIBOR plus 500 plus that X. So it's not going to be symmetric, and there's going to be value transfer. There's going to be value transfer, so it is very important for each organization to know which side of the equation they are on their asset side and their liability side, to understand which part and where it's going to impact them positively or negatively, right?
So Mohit, you know, this conversion is supposed to be value neutral, and what you're saying here, I think you misspoke there, that if it's LIBOR plus 200 today, in the future it's going to be SOFR plus 200 plus a spread. So the and the fact that if you don't do something, that single spread is going to create winners and losers. So you need to know if you're a winner or a loser, and if you're a loser, you don't want to be in that single spread deal. You want to unwind that single spread deal before you get there.
Good point.
But I just want, but my real point is that, you know, it's going from LIBOR plus something to SOFR plus something plus a thing that hasn't been defined yet. So.
That's right. That's right. Good point. Yeah. So, but the issue doesn't quite end there. There is another issue, and that is that the ARC is the decider, the industry decider for the spread on the cash instruments, whereas ISDA, based on their consultation, is going to provide it on the derivatives. The timing of and the cessation triggers and the spread itself could be different between the cash products and the derivative products, which could have implications for tax, accounting, cash flow matching, valuation differences, hedging, etc., for anything that has been cross-hedged, any cash product that has been hedged, or derivatives that have been hedged with other things. So what's the point about all of this thing? Why is it so complex? Well, all these things that we have spoken about make it very, very complex, okay? But adding to the whole thing is there's a staggering number of touch points in the entire ecosystem. That entire ecosystem is talking about there are cross relationships and interdependencies between customers, institutions, their further sale points, downstream sale points, their counterparties. Everybody must come to an agreement as to what it's going to take to convert all these things. That is exactly why the regulators are so concerned that and they're not observing the right level of mobility and the mobilization of resources and planning. That's why they're asking for all these plans yet. They may be even asking, do you have a plan that is robust enough? To our final slide of LIBOR conversion issues. Well, what are we really saying? Why the regulators continue to be concerned is they're seeing, as the whole market participants are seeing, there is continued activity in LIBOR instruments. If there's a mountain of inventory, they're adding to that problem, okay? And the additional issues that represents is that they're going to have to remediate all the additional contracts and the additional instruments between now and then, and the time itself is getting shorter for doing this additional inventory as well. The other part that poses additional challenge is the litigation, the potential for litigation, because the currently aware institutions that are offering their products to customers are now aware, and there's asymmetric information. So there needs to be a communication plan in place to make sure that everybody is on the same page, and it needs to be done. While the markets are rational, players are rational, so why hasn't everybody moved to SOFR yet? Well, most folks are waiting for either regulatory guidance, some hand-holding, some are looking for their banks and their superiors to tell them. Maybe some of them are looking for their management to tell them all the way down that this needs to be done. But many of them are waiting for an efficient period when both the LIBOR market and the SOFR market are going to be liquid enough that the transition is going to be easy. But that's not going to be the case, and we can talk about that later. Bottom line is many things to think through, many actions to plan and execute. For conversion itself, we can assist with that, given that the time fuse is very, very short. Let's go to the separate part of the adoption of SOFR issues here. There are many, many challenges in adopting SOFR, and it's not that simple either. Many issues to tackle, plan, and execute, and the issue that's going to create lots of issues for people and institutions is that the resources required to making the transition need to be budgeted for, brought on board in a timely way, otherwise they will keep getting absorbed by your competitors who get to that issue first. So something to think about as you think about moving over to SOFR. Well, what needs to be done sequentially? So here's some sort of a suggested process. The first thing is to develop internally or acquire from outside SOFR capabilities and resources for the transition. What does that entail? You need to acquire models. You will need to develop them or acquire them, validate them, benchmark them. New curves need to be taken in. You need to do platforming work for that. You need to do integration work for that. There are new processes for SOFR products that you will think about. Any new product that you develop, how long does that take? It takes a long time. But you need to do this for this one because nobody itself is ready, and everybody needs to make sure that there are cross dependencies that will be resolved. There needs to be updates to risk, treasury, and accounting systems. Need to develop, processes even for DFS and for SOX. And those valuation considerations are going to be very important as CFOs and CEOs need to sign off on the true and the best assessed value of the balance sheet on the asset and liability side. And the critical part is the last bullet here. You can't offer new products until you know what it's worth, how to hedge it, how to get your customers to buy it. So it's all sequentially and interdependent. Why is this slide important? Well, given how much we have already spoken about the extent of the issues, this is highlighting the fact that the agenda needs to come from the top. And there needs to be enough prioritization from the top to make sure that there's a governance structure and a system in place that will make this transition tier 1 priority. If you don't have a governance structure, or need help with that, we can assist there as well. Let's go to a suggested timeline for doing this entire transition. When we're going to look at it backwards, okay? From 2021, there are, as we dimension the issues, the dimensions are business, and this was on the first few slides. I think it was the third slide. It is business, it's operations, it is systems, it is legal plus your ancillary enterprise functions, and your financials. But for all of those assessments to be done, there needs to be a broad-based assessment first, so that you can dimension the scope and the scale of issues of your own company. Okay, if you can do that internally, great. Otherwise, you're going to need external help. Then you need to have a communication strategy and a strategy to deal with all these things, and to scope out how and when and how you're going to do it. And the third part is going to be the actual systems work. There's going to be a lot of integration work as the vendors try to absorb these changes in their own systems and try to bring it forth. It's going to be a considerable amount of work at that end as well, for development, for integration, and to make sure that everything is done in a cohesive way. Then you're going to have to know when you're going to stop and in doing business in LIBOR and to have things done in parallel, okay? Because you want to do things in parallel before you want to switch it off. And that's when you want to know how and when to transition over your business and run it in parallel so that you can have a complete transformation that is going to be quite effective. It's not going to be perfect because it's a systemic problem. But if you're better than everybody else, that's what you want to be. Okay, so this is a very telling slide. Time is short, skills are scarce, and integrations are many. Readiness at a global level according to Accenture. Let's look at just some of the key points. Let's look at just the middle one, the 20%. In the second bullet, third, fourth sub-bullet. 20% say they are operationally ready. Now let's consider what that means. Accenture's client base is possibly concentrated towards the larger institutions that are more aware, have more resources, and if 20% of them are operationally ready, then it gives pause to regulators, and that is why they may be sending out these things. New York is the first one, but you can expect more of them to follow. The expectation is that the global spend is going to be $155 billion with a B on technology, staffing, and client outreach work for LIBOR transition, according to Accenture. Okay, so let's ask some questions about your own readiness, all right? Now that you have some sort of a flavor about the complexity and the dimensions of the issues, let's ask if senior management of every company is asking some of these sample questions as governance questions, okay? Have they evaluated, for example, doing everything using internal staff versus using vendors for repapering? Are they using machine learning, artificial intelligence, or not? Is there a categorization, a taxonomy that they have developed? Is it based on asset category, product complexity, customer cohort? There are a whole bunch of things here that we can speak about, but you can read it on the screen. I don't want to go through it. The essential question is, the senior management should be asking, do we as a company have a robust framework and all the resources necessary and identified to repaper all the legacy documents and remediate all legacy products and instruments, things that have been accounted for, not accounted for, in a coordinated way at an industrial pace and scale? For this, you need to have automated solutions, and our partner Pendo Systems can do that very effectively. Let's go to the last page here, slide 18. This is a very telling slide. It basically, it's a self-assessment on your part to see where you are in this journey, and based on what you've heard so far, what you need to do to think about the steps you need to take to get on board of doing something about it. Because if you don't, the regulators will do it for you. So the choice is going to be, can you make a more advantageous step by doing it yourself first? And those are the kind of things we can help you think through to mobilize, to make it into action, and to present viable solutions and help you transition in an effective way. Thank you for attending. This is the first episode of our discussion on this topic with the industry, and we would like to have a conversation one-on-one if you desire to, with your own LIBOR transition and transformation journey, and how we can assist with that in our in our own ecosystem that is highly specialized, highly effective, and is made up of a lot of experts who know what they're talking about. With that, I'll hand it over to Bill.
So first off, thank you, Mohit. If people would like to type questions into the question window on the platform, please. We have a couple here for you. The first one is, what are the different ways SOFR term structures can be built? So you would reference that SOFR is just an overnight rate, but in many cases, like it's going to replace something that's based off 1 month LIBOR. Are in different industries, is there a standard for tackling that problem yet? Like different industries attack it differently?
Let me understand the question. The question is that how do you create a term structure of SOFR?
Close enough, yeah.
Okay. That's going to be a very complicated answer, and I don't believe I can do it justice enough right now in the time frame we have, because that's going to be a confluence of many, many actions on the part of buyers and sellers to be able to, and the regulators and the platforms to offer products. The customers have to go along with it. It's going to be development and organic development of a completely brand new benchmark, and those don't happen overnight. They take time to develop. Consider, for example, LIBOR, when it was first instituted, it was not as pervasive as it is today. It took a long time for it to get to the stage where it's at. So how quickly does it develop? I don't know the answer. What does it take? I think it's going to be a social and an economic and total confluence of many things together.
We have a similar question that was asked. Are you able to speak to when and what type of average SOFR rate will be created? So, I mean, I think Fannie and Freddies in the mortgage industry, for example, have put forth instead of using a specific day of SOFR, since it is only an overnight rate, of creating a 30-day rate by averaging the 30 days of SOFR. Is that, I don't know if that's what that person asking the question is speaking of, but, and then using that as that average 30-day rate as the equivalent of a 1 month LIBOR rate. That's at least what we can think of, but I would think then that the New York Fed would be doing that type of calculation and publishing it. And so where you have language today that says it might be, you know, I'm going to look on the Wall Street Journal 45 days ago, I might be looking at the New York Fed 45 days ago for the 30-day average rate. We have another question about some lines of business seem to be further along than others. We originate student loans. Do you know the status of where the student loan industry is?
Great question about the student loan industry. So the student loan industry has seen a lot of consolidation. So the student loan industry has a lot of more variability in their contracts, in their products than the other industry, and there seem to be less advanced than the fixed income, the other fixed income market right now, and that is the general impression, and they would need to pull along a little bit faster. The issues to them are going to be the same as we have discussed so far. They can go with alternative indexes as well, but if the choice is going to be SOFR that is being proposed by New York Fed and the Federal Reserve, then for hedging that product, that might be the best way to go. And that's going to be the case for all alternative reference rates as well. The choice is going to be, what do your customers want? What is best for you? And how can you hedge it best in markets? For example, the CME is now going to force the issue by doing SOFR contracts as well, and stop taking LIBOR contracts. So that's going to force the issue from a market standpoint as well. But if there are no contracts on other alternative rates that are being proposed, then that's going to be a less liquid market, and one needs to be cognizant of the risks that you're taking.
Okay, thank you. We got another question. How will the LIBOR futures market, euro dollars, and swap futures be affected? Great
question. So that's a great question, because all of them are going to be impacted, because consider how the swap market is built out, right? I mean, the swap market is versus 3-month LIBOR. Now, if 3-month LIBOR does not exist, that means that it's going to now require redevelopment or a readjustment of the swap, the fixed rate swap points out the curve based on how SOFR is behaving as the 3-month contract term evolves. So that's going to be work in development, and basically the markets are going to adjust for that. The regulators have proposed, but the markets will adjust, and they will create adjustments in the process.
Okay, thank you. Please keep the questions coming, people. Based off of the chart that compares SOFR and LIBOR, it doesn't seem that SOFR is actually a great rate for lending. It doesn't have credit risk. It doesn't have other factors in there that are in the LIBOR rate. Should we be considering other reference rates? And I think this is one of the questions that the New York Fed actually asks you to do, is to assess what your alternative rate structure might be even. But you're shaking your head no.
Great question. I'm shaking it in the sense of total agreement, because I could not agree more. Everybody has to make their own assessment about what is the most representative rate for them to use based on what their customers want. You cannot, as an organization, transition away from or transition into a rate that your customers don't want. You got to sell the product. You can sell it, but now it's going to be a question is, are you going to warehouse it, put it on your portfolio, or sell it forward? You have to think what the next sale point is. What product do they want? If you're going to keep it inside on your portfolio, you have to think about what are the best and most effective hedging strategies. And mind you, with all this being said and done, the challenges for vendors and platforms are going to be many as well, as they try to create liquidity in these kind of, CME, for example, as they try to create liquidity in these products. But ultimately, it's an economics in a markets function, capital markets function, where there are going to be buyers and sellers, and the most liquid products are going to have the least amount of bid ask and so on, and it's going to make things so you would have to really choose your most effective hedge. Not everything has to be optimal, okay? Not everything has to be optimal. You just need to make the best choice. And for this DFS letter, you need to show that you've thought through all these issues to present it as part of the plan, okay? You don't have to have the plan. You don't have to have all the solutions yet, but you need to think about all these issues and how you're going to effect them. Have you identified the vendors who are going to help you? Things like that.
Okay, thank you. Another question. I'm from a small mortgage company, and you guys have used some terms that I don't even understand. Could you please make this a little bit more real for me? If you don't mind, I'd actually like to start this off. So as a small mortgage company, I'm assuming that you originate ARM loans, and let's assume you retain servicing too. So when we talk about products, that would be probably your main product. It may not be your only product, but the LIBOR ARMs that today you're originating for Fannie and Freddie. And if you're originating jumbos, then you originate for other investors, or maybe you, if you're small, you probably don't keep them, but if you were a small bank, you might be retaining those LIBOR arms on your books. So when we talk about products, at least on the asset side, those are some of your assets. You may have borrowings that are related to that as well. And we know that LIBOR is going away. So if you're still originating these loans, when you mentioned information asymmetry before, as part of your communications plan, you should be already telling borrowers that we're originating this loan that uses an index, and the index will be going away, and you should be, your loan officer should be providing information. There should be something in your closing document. So that should be part of your communications plan. And then, you know, you will need to do an assessment of your company of where does LIBOR occur. So we already know it's going to occur on the origination side. Let's assume it's going to be on the servicing side. It's going to be on the loan delivery side. It's going to be in your risk management. If you outsource risk management with a vendor, then you're going to have another counterparty connection point there. You know, we talked about some of the aspects of your communication plan with your customer, but you're also going to need to have a communication plan with your counterparties, your investors, your vendors, a bunch of other people. If you are servicing loans, you're going to need to go back and actually look at all the loans and see what the fallback language is. And if you're small, you probably haven't done acquisitions. But if you're a larger lender and you have done acquisitions, you're probably going to have a variety of languages that then lawyers are going to need to parse apart and understand when the transition for those can take place, when it's clear, when it's not clear. So then there's the actual repapering of that, but that would come after you have the consistency, and you know that repapering should be value neutral. It will be a problem if a loan, for instance, is a LIBOR arm is in workout, but you won't know that until you actually do it. But you will have to acknowledge that in advance. Would you like to?
Yeah, great point. I'd like to add there is we've seen in our interaction with Pendo's collateral and their extensive work that they've done on some of this investigation of servicing related loans, is there are places where doing business as usual can present problem as well. There may be some instances, for example, where doing business as usual, if the index is not available, in this case LIBOR not available, then if it is replaced by something and if there's a shortfall of monies to be paid through, then the servicer is liable for all such shortages until the end. So it is very important to know the quality of the documents that you have, where they've been acquired. There's been a lot of consolidation in the industry, so business has not been exactly how the parent company may be doing business today. But you need to look at a lot of depth in your entire organization. As banks have consolidated, products have consolidated, papers have consolidated, there's different kinds of language as well. So we need to think about all of that.
Okay, thank you. Thank you for that question. The next question is, you guys just talked about agency-backed products. How will bank balance sheet products and portfolio be impacted by this?
So banks are going to be impacted, bank portfolio products. I mean, think about if you're thinking about, let's say, business lending. So you have to think about wholesale lending, syndicated lending. You need to first assess what the exposures are, what the financial risks are, how much of undrawn commitments are there. Do you even know how much of that is LIBOR-based and that's going to become SOFR-based? So it is very important to first assess and dimension the scope of how big the issue is at your organization. Then it's going to be a question of how it's going to be impacted financially if this moves, but that is going to require economic and financial analysis based on assumptions, based on how the market's going to go. It's going to be an interactive discussion of a high subject matter expert consulting that we can provide to individuals not very easy to answer off the top of my head because the issues are going to be multi-dimensional.
Right, but I would think, you're going to have the same repapering issues that we talked about, where you're going to have to look at each one of these products and see, does my contract even have fallback language? Is the fallback language clear? And even if my lawyer thinks the language is clear, that their lawyer, your counterparty's lawyer, agree, it will need to be switched to a new index. So you will need to renegotiate it, and then it will affect all your models. And,
Great point.
You'll have to. I know some people advocate that you should probably refinance all of this stuff. It's the only way to really get to something that's truly value neutral. So even if you've got them internally, it's certainly going to have, you're going to have many of the same issues, and then it's still going to ripple through your processes of, now that it's based off a new reference rate, how do I hedge it versus how I was doing it before, I would think.
All policies will be impacted. And this is a topic for possibly our next episode, but all policies will be impacted because valuations of even fixed rate products as SOFR to swap curve conditions evolve. So all derivative hedging concepts will change as well. And that's something to be put in policies and governance as well.
Okay. There's another question coming through. Do we know if Fannie Mae and Freddie Mac's fallback language has remained consistent, or has it been ever modified? Maybe ever been modified?
Do not know the answer to that. I would defer that question back to the GSEs, but it is my understanding that they have come up with the most robust language now jointly, and that was published by the MBA as well recently on another. So I would ask you to go to Freddie Mac and Fannie Mae's websites. They have enough disclosure and information around that. But I don't know if they've ever changed it piecemeal over time. I do not know the answer to that.
Okay. The next question was also an add-on to Freddie and Fannie, so about does the language vary by state? And I don't know the answer to that. But Freddie and Fannie seem to be pretty far ahead of many other people on the curve on this, and they both have very good websites that might address this question on their website.
But if you don't find the answer, I think it would be helpful to reach out to your representative or your customer contact at the GSEs. They're very responsive about this.
Right, but although that's a very good question, I will remind people that unless you only do Fannie and Freddie loans, or maybe those are the only loans that you service, that all of the loans that you do for other investors are going to potentially have different language in them. And so it's not just a Fannie Freddie issue. It could be your own products or products that you did for conduits or any other investors. So, do we have any more questions, Lauren? Okay. Do you guys have?
Sorry, took me a second to unmute myself. No, that is all the questions that have been submitted.
Okay, I thought there would be more. All right, we might as well end this then. So thank you everybody for attending. I hope that you find this valuable. Please leave feedback one way or another about that. And thanks very much.
Thank you very much. And please submit, if you have other questions, or submit. Can I suggest that we submit them to Lauren, and maybe we can come back to you individually about them?
Right. Lauren's email is on the last page of, it's on your screen right now, but it's also the webinar email came from her. So.
Yep, absolutely.
Excellent. Thank you all. Thank you all for attending. Hope you will attend our next one.
Thanks, everyone.